Just turn the recording on so that we can have a video of this afterwards presented. Incidentally, all the videos, besides being on my YouTube channel, are now available on the Learning Management System. You can also upload on the Learning Management System the slides, and you can either view them on the screen as they appear when I present them, or you can get a downloadable handout of the slides to print out if you want. So all of those things are available. Okay. Just load up our presentation for this morning. So we're going to talk about Workbook 3 accounting processes. This is quite complicated, and I'll go through it as carefully as I can. Please type in any questions if you want me to pause at any stage to explain something further. What I'm going to talk about is, first of all, the government accounting process, and most of the presentation will be about the 4 accounting bases: cash, modified accrual, full accrual, and then finally the budget classification and the chart of accounts. First of all, the government accounting process. I think the point is that government accounting and commercial accounting are fundamentally the same, but there are some important differences which affect the way you keep your records. The first one is that many countries, and including Somaliland, use cash accounting. We'll explain in a few minutes what we mean by that. Secondly, there's a requirement for quite a considerable amount of additional information outside of the traditional accounting system. We've seen some of that when we looked at budget execution, information on commitments and on fund release, for example. And as we'll see today, you get a more complex chart of accounts for government entities than for the commercial sector because you require more analysis. So although fundamentally the same, there are these differences. There's a list in your workbook which summarizes these. First of all, we mentioned information is often recorded on a cash basis. Extensive use of memorandum records not part of the double entry system. The commitment ledger is an example of that. It's not part of the accounting system, but it is an important part of your budget execution control system. And largely this is because you need to record information on budget adjustments, environment, supplementary budgets, fund release and commitments. You need to analyze each transaction in many different ways, so you may well need to record an item of expenditure according to the type of expenditure, the organization which spent it, who funded it, what program it relates to, what geographic area it's in, what impact it has on different groups within society. And also there's a lot of transactions which don't involve any transfer of value. When you deliver a service, an education service, you're not actually transferring value in a financial sense, but rather in a social sense. And I just want to make the point about this tracking transaction stages a little bit more. We've used this diagram before and I'll use it again. It's a very important diagram. It shows the stages that any expenditure goes through and all of which have to be tracked in a government system. The first two are the budgeting and the issue of warrants, that's budget management. Commitment management, the commitment ledger through the commitment system. The liability, if for example you buy a vehicle, when it's delivered and billed, that's a liability. That's when you record the expenditure under accrual accounting. And finally, when you make the payment, that's expenditure under cash accounting. So multiple stages, 5 stages of an expenditure transaction, all of which should be recorded within a government system. Not all parts of the accounting system. The accounting system is really only the last 2, the accounting base. Okay, let's go on to talk about accounting base. There are 4 accounting bases that we need to talk about: cash, modified accrual, and accrual. The cash basis is recognized in the cash basis IPSAS, International Public Sector Accounting Standard. 2 and 3, modified cash and modified accrual, are not recognized. They're widely used, but there's no official recognition of those bases. This does mean that there is no precise definition of them. Accrual accounting, well, that is what Accrual IPSAS and also the IMF Government Financial Statistics GFS manual are based on. And just to repeat, commitment is not an accounting base. It's a budget management methodology. What's the advantage and disadvantages of these different accounting bases? Well, the answer is that solutions are appropriate to each country. You can't say absolutely that one basis is better than the other or the right one for everybody. The solution's got to be appropriate to each country. And we'll explain those by considering a case study of financial reports under each accounting base. Now, this is in your workbooks, but I have expanded it to include a budget. I've sent this out on Facebook. I've sent a copy to your tutors, and I'll upload the file with this data in it, with the budget data in it, and put it on the learning management system. So you can all download this data and look at it. But it's exactly the same as you've got, except for the budget column, which I've added in. Because the reason for that is that I decided it was important to show how the budget and budget comparison would be reflected. So let's start off with the cash basis. Cash basis is really very simple. It just records cash, cash receipts, cash payments, cash balances. Notice in red at the bottom the definition of cash. Now again, this is in your workbooks. It's taken from International Public Sector Accounting Standard number 1. It's a broad definition of cash. Cash means cash in hand, notes and coins, bank balances, both current and deposit. Cash equivalents, which are short-term investments where there's no significant risk of a loss and they're convertible to cash in less than 3 months. These would be investments that you make probably in government bonds where you've got some temporary spare cash and you want to get a better rate of interest than a bank deposit account. All of those are treated as being cash, are included when we do cash accounting. So, as we say, simple. And the second point is that cash basis of accounting, it's directly related to a cash budget. Now, this is something we'll talk a bit more about, but budgets are normally kept on a cash basis. They predict cash inflows and cash outflows. And since the cash basis of accounting is also on a cash basis, it gives you a direct linkage. And also, cash is linked to the fiscal balance. What we mean by that is that in all systems, cash inflows and outflows must balance. Any difference will be reflected in a change in your actual balance at the end of the period. You increase or decrease your cash. Cash inflows are revenue receipts plus financing inflows. I'll explain those in a moment. Cash outflows are cash expenditures and financing outflows. And in the long term, they've got a balance. In the long term, unless you want to build up large amounts of cash by having a cash surplus, or you have a cash deficit which you've somehow got to finance, which you will do through your financing flows, they will ultimately balance. And I've talked about financing inflows and financing outflows in the box underneath. This is related to loans. Any government will have loans made to it, either commercially or borrowed by an institution such as the World Bank, and it will make loans, typically to organizations that it owns. If the government receives a loan and you get money from that loan, that is a financing inflow. You also get a financing inflow if you have lent money to somebody else and they repay some of that money. So both loans to government, new borrowing, and loans by the government, repayment, are financial inflows. And the opposite of that, financial outflows, are repayments from money the government has borrowed or new loans which the government makes. And also notice on the right that interest is not an expense or, interest is an expense or a revenue receipt. It's not a financing flow. So you must keep interest separate from payments of principal on a loan and deal with them separately. Now, financial reports. You did look at this in the introduction to PFM, but I'll repeat again. Under the accrual IPSAS, there are a total of 6 reports that make up your annual financial reports. The statement of financial position, what's normally referred to as the balance sheet. The statement of financial performance, which is the same as the profit and loss account for a commercial entity, except of course the government doesn't make a profit or a loss, so it's called the statement of financial performance. Sometimes the statement of financial performance is called the operating statement. Means exactly the same thing. Statement of changes in net assets stroke equity. This is the total change between the opening balance sheet and the closing balance sheet. The cash flow statement, sometimes referred to receipts and payments, a comparison with the budget and your notes and accounting policies. If you're using cash basis reporting, you will have just 3 of those. You'll have a statement of receipts and payments, a budget and a comparison, and your notes and accounting policy, although your notes and accounting policies will usually be much shorter and simpler. Right, let's look at those. And let's start off with the cash basis. Now, this is using that data in the example that we've got. And it's simply a matter of picking up the cash flows and putting them into a cash flow statement. You start off with your opening balance. So it's not just flows, it actually shows how the balances change as well in a single statement. You then put your receipts, your fees, and your grant received. Notice you put the cash amount received, not the amount you invoice. This isn't accrual, just the cash amount you receive. Your payments. Well, you didn't actually purchase the vehicle well, you did purchase it, but you didn't pay for it in the period, so there's no cash flow in the period, so there's nothing against vehicle purchase. Payroll, expense advances, this is just the amount advanced in the period, not the amount that people submitted their returns for, it's the amount advanced. Operating expenses, again, the amount of cash paid. The loan repaid. Although the loan repayment is a financing flow, it goes into your cash flow statements of receipts and payments because it is a cash flow, together with the interest that you pay, giving you total payments of $170,000. Your cash flow for the year is negative at $5,000, giving you a closing cash balance of just $5,000, the opening balance minus the cash outflow for the year. Quite simple. It only shows cash flows and balances. It's not comprehensive. It doesn't get any operating surplus or deficit, so you can't use it to measure performance, and you don't get a balance sheet of assets and liabilities, so you lack information and there's no control over assets and liabilities. So it does what it does, but it is limited. Let's next look at the modified cash basis. Now this is There's no precise definition of what we mean by modified cash accounting. As I said at the start, there is no official definition of modified cash. The usual way that the term is used is the way that it's described in this slide. And for example, a recent book that's been published on this by the IMF uses this definition. And there are two changes from cash accounting. The first thing is that if you write a check, let's say in December, and it's not cleared and doesn't go through your bank until January, you treat it as being a December payment. You effectively keep your books open for a month after the year end for checks that were written in the year. And the second thing is that you will deal with advances and deposits on an accrual basis. Advances typically will be advances to employees for expenses, and they can be quite a significant and substantial area to control, and most countries prefer to do this on an accrual basis, even if they do use cash accounting. That does mean that you'll need to set up a ledger accounting system for your advances and deposits. You don't really need a ledger accounting system for cash accounting, but you will if you use your advances and deposits on an accrual basis. Look at the financial report under a modified cash basis, and I've ringed the things that are different. Opening balance is cash, but you also have an advance outstanding of 5,000 at the start of the year. Again, this is the data in that list of information. Your revenues are the same, fees received and grant received. Your expenditures, payroll is the same. Advances, now we no longer show the cash amount advanced, we show the amount approved. I'll explain that a bit more in a minute. So I'll come back and show you the advances, but in there we have the amount approved, not the amount paid. It's on an accrual basis. Payment of the vehicle now goes in because it was made in January, but the check was written in December. And so we get this quite different picture, showing, in fact, a net deficit for the year of 18,000, not 5,000. Let's look at these advances in a bit more detail. These expense advances, you started off with an opening balance of 5,000. You advanced 6,000 in the year, that's your cash flow, giving a subtotal of 11,000. You approved claims of 4,000 in the year, that's your accrual expenses, which we show on the modified cash basis. And your balance at the end of the year is 7,000. So that's how we get the figure that's in the cash flow statement and the figure that's in the modified cash basis. And that's the same figure we'll use, you'll see, when we go on to look at modified accrual and accrual accounting, because basically we've now moved the expenses to an accrual basis. And we've got a budget comparison here. The budget comparison shows the revenues, actual and budget, all the expenses. New expenses advance, ignore that line. So we've got the expenditures as budgeted and as actual, and the third column shows the variance. And we have a variance of 5,000. We expected assets to go down by 183,000. They've actually gone down by 100. Sorry, looking at the wrong line. Sorry. We expected the assets to go down by 18,000, and they have gone down by 18,000. So overall, there's no variance between the budget and the actual. But there are significant differences in individual line items. One of the limitations of modified cash basis, well, we said it's not recognized. There's no official definition, but it is quite widely used, in fact, very widely used. In fact, until a country started moving to accrual basis, it was probably the most widely used basis of accounting. It's got the same limitations as the cash basis, Plus, it's really muddled. I mean, in one report, if we go back to this report, you've got some items on a cash basis and some on an accrual basis. So it's muddled. And it doesn't produce any sort of meaningful balance sheet. I mean, if I put up a balance sheet of what are the assets and liabilities, they don't mean anything, because some are accrual, some are cash basis. There's no conceptual basis, and therefore it's difficult to analyze the information. As you'll gather, I personally don't like the modified cash basis, despite the fact that it's widely used. Can we do better? Modified accrual. Again, no official definition, but this is the definition that we use. It recognizes transactions when cash, financial assets or liabilities are paid or received. And we now get a statement of financial position, a balance sheet of financial assets and liabilities. To make that a bit simpler, it's the cash basis plus financial assets and liabilities. Financial assets and liabilities, basically we're talking about lending. So you add to cash loans, long-term loans, short-term loans, and also amount that you owed for unpaid bills, because they're a liability. It enables you to have a cash flow statement, which we'll look at in a moment. You also get an operating statement for financial flows, and you get a balance sheet of financial assets and liabilities. Now, under this, we've got more to look at. First of all, we have a cash flow statement. As it says in red underneath, this is the same as the statement of receipts and payments, but slightly reorganized in that we take investment flows, and in this case that's the loan payment. We take the investment flow and we show that separately. The cash flow is exactly the same as under cash flow accounting. It can change. Notice that we do not show the motor vehicle purchase in this cash flow statement. So we're going back to the same figures as we used in the cash flow statement. In the statement of receipts and payments under the cash basis. Because the motor vehicle was not paid in the period, it cannot appear in the cash flow statement. But it does appear in the operating statement. Now this shows your revenues, but you now show your revenues on an accrual basis. I'll show you how that's calculated in a moment. And you also show your motor vehicle, which is expensed in the period, and operational expenses on an accrual basis. I don't need to explain the motor vehicle. You know what I mean by that. It's a liability at the end of the period, not a cash outflow, but you did purchase in the period, so you do show it in the modified accrual basis because you've incurred the liability. Let me show you some workings of how we get at these figures. First of all, the fee figure. We had an opening balance of the amount owed by students of $40,000. $55,000 is invoiced in the year, and that's the revenue figure for the income from fees, $55,000. The students paid $65,000 in cash. They paid more than you invoiced because they were paying off some of the previous year's balance, which now becomes a closing balance of $30,000. So just to go backwards, you will see that in the operating statement, we show fees as $55,000. In the cash flow statement, we show the cash received of $65,000. Because one is the figure for revenue and one is the figure for cash flow. And your operating costs, same principle. We had an opening balance of $15,000. Invoiced during the year was $30,000. You that's the balancing figure. You've got to calculate that. The amount paid during the year was $45,000, and there is no closing balance. All of the opening balance and the amount invoiced in the year was paid off. So we have an expenditure item in the operating statement of $30,000 and a cash flow of $45,000. Again, if I go back, you can see those. So you can see that operating expenses cash flow is $45,000. Operating expenditures, operational expenditure cash revenue expenditure flow is $30,000. It's a move from a cash basis to an accrual basis. However, notice that the motor vehicle is still fully expensed in the period. We're not using anything like depreciation under modified accrual, so if you buy a fixed asset, the whole of the cost of that will show as an expense item in the period. We now have a balance sheet under modified accrual, only showing financial assets and financial liabilities. So it shows the student fees that are owed to us, advances that haven't been submitted, for expenses that haven't been submitted, plus of course our cash balance of $5,000, giving total financial assets of $42,000. And we have liabilities. We owe $15,000 for the motor vehicle because at the end of the year it has not been paid. And we have a long-term liability of a government loan of $56,000, and you can see how that's calculated in the workings at the bottom of that slide. It's the opening balance less the amount repaid in the year, giving the closing balance of $56,000. And we can produce our budget comparison. Notice that on fees we are comparing not the amount of cash received, but the amount of fees that were billed in the period. Grant received is as expected. Payroll costs slightly under budget. Expense costs, interest paid. Motor vehicle, we had a budget of $21,000 for the motor vehicle, so we've substantially underspent on the motor vehicle. And operational expenses, we had a budget of $48,000, we've only spent $30,000. So a substantial saving on both of those. Meaning that overall, we have an actual surplus or deficit, in fact, of $9,000. We budgeted for $22,000, so we're $13,000 better off than we expected to be. And finally, notice that you can reconcile that. Now, you can go back and check these figures, but if you work it out, the opening net assets were $20,000. The deficit for the year, as shown on that statement, is $9,000, and the closing net assets, as shown on the balance sheet, are $29,000. So we can show the movement on net assets. The modified accrual basis isn't recognized, but it's widely used. It actually provides most of the information you require for fiscal control. You really don't get enough from just cash or modified to cash accounting, because you don't know the amount of loans, you don't know the outstanding bills. But with modified accrual, you do have that information. However, it does not enable any control over fixed or intangible assets and liabilities. So it's less useful for control purposes, and you don't get a proper measure of operating surplus and deficit. You get this modified accrual one, but it isn't really a meaningful measure of your operating surplus or deficit because of the way you treat fixed assets. You expense them completely in the period. And that means that if you buy something very expensive in one period, which lasts you over 3 or 4 years, you are distorting your information over that period of time. So we need to go on to accrual basis. The accrual basis is, of course, comprehensive. It records all flows and balances relating to all assets and liabilities. It's a comprehensive control and reporting system, and it does properly measure the operating surplus or deficit, and therefore the most useful information for performance management. But it's also the most complex. Let's look at the example and what emerges from that. First of all, the cash flow statement is exactly the same as the cash flow statement you get under accrual accounting, under modified accrual accounting. Modified accrual and accrual accounting, cash flow statement, identical. It is the cash flow. That's easy. The heading on that is wrong. Sorry, I don't know why that heading is in there. This is the accrual, not the modified accrual statement. Operating statement. My mistake, I typed in the wrong heading on that slide. Revenues are the same as under modified accrual. Expenditure is the same as under modified accrual, except that the purchase cost of the motor vehicle is now replaced by the depreciation on motor vehicles and equipment. So the only change in this statement from the modified accrual basis is that you've replaced the total cost of the vehicle with the depreciation charge. And this schedule, which you should always produce if you're using accrual accounting, it should always be part of your notes to the accounts, shows how you calculate your fixed assets and your depreciation. You take the opening cost, which was given to you, you add your additions to get the closing cost of the vehicles. Depreciation, you take your opening balance of depreciation, and then you depreciate the assets during the year according to the basis that's been given to you, which was 25% for motor vehicles and 10% for equipment. And that's calculated on the closing balance, giving you your total depreciation charge and also showing you what your accumulated depreciation is at the end of the year. And although we don't actually show it, need to show this information in this way, we also get what's called the net book value, the closing cost minus the closing depreciation. I'll come to the budget in a moment, but that's the top table, shows you how you calculate the depreciation figures, which then appear as your expenditure item in your statement of surplus and deficit. Now, when we come to make our budget comparison, it's fairly straightforward because it's again the same as the modified accrual basis until we get down to depreciation. And let me go back to the previous slide to show you how we calculate the budget depreciation. And this is important. The IPSAS requires that you must have a budget comparison showing budget and actual on the same basis. So you either got to convert your budget to an accrual budget, or you've got to convert your statement of surplus and deficit to a cash basis to compare it with the budget. The IPSAS does not say which of those two options you should use, but you cannot compare an accrual statement of actual with a cash basis of budget, because you are not comparing like with like. You must compare them on the same basis. On this one, really for simplicity, I've assumed that you've got an accrual budget. Accrual budgets are quite rare. The United Kingdom has an accrual-based budget. New Zealand has an accrual-based budget. Australia has an accrual-based budget. And I think those three countries are the only three countries in the world which have accrual budgets. Even if countries use accrual accounting, most countries use cash budgeting. And in those situations, you've got to decide, are you going to adjust your budget, or are you going to adjust your statement of operating surplus or deficit to put them on the same basis. I'd say in this one, we've assumed that you've got an accrual budget, and this is how you calculate the depreciation. It's somewhat simpler because we've only got to calculate one figure for motor vehicles and equipment. We take the opening costs, which of course don't change, the budgeted expenditure, and then we can work out the budgeted depreciation. As the budgeted expenditure was higher, the budget depreciation is higher. Sorry, the wrong way. As you can see here, it's $1,500 higher. Equipment, you didn't have any purchases, you didn't budget any, so it's exactly the same. And this comparison shows that you budgeted to have a deficit of 12,750. You've got, sorry, 21,250. You've got an actual deficit of 12,750, so you're $8,500 better off than your budget. Let's get some conclusions on this. First of all, on the accrual basis. The accrual basis is recognized in IPSAS accrual standards, and the IMF Government Financial Statistics, GFS, is based on accrual accounting. Most accountants regard accrual accounting as the goal for all countries. However, only a very few countries have fully implemented accrual accounting. And you will find that although quite a number of countries claim to have accrual accounting, when you examine them in detail, you find that they've only partially implemented accrual accounting. For good reason. Accrual accounting is complex and you need substantial resources to implement it. Human resources, trained staff, institutional support resources to be able to undertake that, and also technical resources. You need good accounting systems. This budget comparison is a problem. If you've got a cash basis budget and accrual accounting, it makes the comparison much more difficult. And of course, you still need cash flow information for fiscal and budget management purposes. In fact, in the United Kingdom, which uses accrual budgeting and accrual accounting, a lot of the managers still prefer to control their budget on a cash basis because they can understand it more easily. So let's have a look at this. If we take all of the figures we've just calculated and compare them to the budget and the variances, we get quite interesting conclusions. Now, this table is not in your workbook, but it'll be in the slides which I'll issue to you. Under the cash basis of accounting, we get the cash surplus or deficit, which is $5,000, which actually stays the same all the way through. I mean, every basis that you use, you still require to have a cash flow statement of receipts and payments. And you cannot change your cash surplus or deficit. It is what it is. And that shows that you have a cash deficit of $5,000, whereas you expected to have a cash surplus of $4,000. So your cash flow is $9,000 worse than you expected it to be. That's that. Now, under modified cash, you get an operating statement showing the surplus or deficit, which shows a deficit of $18,000, which using the same basis is exactly the same as you calculated. So according to the modified cash basis, you are exactly on budget. Great. But when you look at the modified accrual basis, You actually had a deficit of $9,000. You budgeted for a deficit of $22,000. So on that basis, you're doing $13,000 better than you budgeted for, which looks good. But if you apply full accrual accounting rather than modified accrual accounting, you find that you've got a budget deficit of $12,750 as against $21,250. Still better than you expected, but only better by $8,500. So 4 different bases of accounting, and when we compare them to the budget, each gives us quite a different conclusion. So what does it tell us? Well, it tells us the results are different, that's obvious. Secondly, it tells us the cash surplus or deficit is fixed and required under every basis of accounting. So the cash is what cash is. As accountants, we claim that the accrual basis gives us the best measure of the surplus or deficit, and therefore the final row in that table is the most meaningful conclusion. And that is probably correct. Although when you go on to study this in more detail in the SIPFA IPFM course, you'll see to what extent it is actually difficult to calculate the profit, the surplus or deficit, and the number of options that are available. But that's going beyond the level of this course. So at this stage, we can conclude that they give different results. Cash is important and remains constant. The operating surplus or deficit under accrual accounting is the most meaningful. So some conclusions. Well, the first conclusion is that for every country, the first stage is to produce cash basis financial reports compliant with the cash basis IPSAS. If you're using, as happens I believe in Somaliland, some form of modified cash, then you need to be able to work out what your cash flows are and to produce cash flow statements without any element of accrual. That's the first thing you've got to be able to do. If you can do that and you can produce reports which are compliant with the cash basis IPSAS, this is a good basis to build on. For most countries, modified accrual is a reasonable goal. Full accrual may be for the very long term, but unless you have got considerable resources to spare, if you can get to modified accrual accounting and reporting, that should be sufficient. And then regard accrual as the ultimate goal. It's a major task. It took the UK 10 years to implement full accrual accounting. And there is an opportunity cost of the resources that you will use to implement full accrual, which could be used for other purposes. So for most countries, other than rich and very well-resourced countries, although accrual may be the ultimate goal, it is not something that you should be rushing towards. Okay, let's move on to budget classification and chart of accounts. Now, this is a big subject area, and we're really only introducing it in this course. I want to take that definition that you've got in your workbook and break it down into a series of points. What is financial classification? We use the term financial classification to include both the budget classification and the chart of accounts. And the definition reads, the revenue and expenditure categories established by the government. So your government fixes the classification. And if you're in the Ministry of Finance, that probably means you. It's used to plan revenues, expenditures, financing, and other financial flows. I'm not sure what other financial flows there are, but you use your classification system for budget planning. Subsequently used as codes in the accounting system to classify actual revenues, expenditure, financing, and other flows. So you use the same codes in your accounting system as in your budget system for classifying the same item. And you also use codes to record assets and liabilities. If we look at the relationship between the budget classification and the chart of accounts, the budget classification is on the left. When you put it into the chart of accounts, you need additional codes. You need codes for transfers, cash in transit and things like that. The budget doesn't record assets and liabilities. I mean, you budget for flows, so you need asset and liability codes. You will often need more detailed analysis than you've got in your budget, and the budget will excuse me, will not break down your financing flows in the way you need to do in your chart of accounts to record your receipts and payments of income and of principal. So your chart of accounts is based on the budget classification, but will include quite a lot of extra codes. We generally talk about the dimensions of financial classification, and this is where we differ from the classification that's used in the commercial sector, which will usually be much simpler. It would usually be just the first two, economic and organizational. Economic classification is the type of expenditure, wages, maintenance costs. It tells you what the money is spent on. The organizational classification tells you the entity incurring the expenditure. It tells you who's responsible for the expenditure. The functional classification is really there for data analysis. And you should use for this purpose the internationally recognized classification of the functions of governments called COFOG. That's in the UN System of National Accounts, and it's in the IMF Government Financial Statistics. The great advantage is that when you compare different countries, the functions are classified on a standard basis, whereas organizationally countries might be classified separately. Your program codes, if you've got program budgeting, and we briefly touched on program budgeting when we looked at budgets. If you've got program budgeting, you need a program classification. It tells you the goal of the expenditure. Geographic expenditure, most people will want to know where the money is spent, particularly in large countries, how much is spent on each region or district of the country. Source of funding, particularly if you get a lot of your funding from outside sources, donors, such as the World Bank, they will want to know where their funding is being used. The source identifies this. And finally, social group. Budgeting is not neutral. Budgeting will have an impact on different social groups. By the way you measure and report this, you could influence the way money is spent. For example, expenditure on, say, pregnancy testing and support to pregnant women will obviously only benefit females. And if you want to focus more money on females, then you will need to look at the type of expenditure organized and presented in a way that reflects that. And you can also use this to measure the impact on castes, on clans, on poverty, on ability or disability, for example. Now, that's getting quite sophisticated, but it can be very important indeed. And this just gives an idea of these different dimensions as they might be represented in a code structure. The number of X's is just for illustration. It doesn't mean anything. Now, what you can see is you can end up with a very complicated coding structure. And just to look at these dimensions in a hierarchical way, the organizational dimensions will always be organized hierarchically. So at the top you will get, for example, ministries, subdivided into departments, and then subdivided under departments, for example, for higher education between different universities. And similarly, the economic dimensions will be organized hierarchically. So you've got a category of goods and services, which might be subdivided into equipment and building costs, and then building costs into rent and utilities. I mentioned the IMF GFS, the GFS manual, GFS-M as we call it here. The IMF GFS manual actually does set out a classification coding structure with numbers and headings, a very detailed classification structure. Now, I'm not going to go through this diagram, and you don't really need to understand it in full detail. I think you need to know that it exists. The IMF GFS is actually a good basis to build your own country classification structure. In some areas, it gives more detail than you probably want. In other areas, you will find that it doesn't provide the analysis that you need, particularly to report according to IPSAS. So if you're going to use the GFS classification structure, you will need to modify it so that it can achieve what you want as a country and to achieve IPSAS reporting. That's quite a big exercise. In fact, setting up a classification structure for a country is a complicated exercise. But as I say, if you're building one from scratch, the GFS classification is actually a good starting point. Some conclusions on financial classification. The first thing is that the budget classification and the accounting classification must be consistent. As we have explained, the chart of accounts will have additional codes, but the codes which are overlapping must be the same between the budget and the chart of accounts. Unless you do that, it becomes very difficult to make a budget comparison. It may sound obvious, and most countries, and I think Somaliland is one of them, that this happens quite automatically. You base your chart of accounts on your budget. Not everywhere. There are countries which have completely different systems. Secondly, your coding structure must enable both GFS, IMF GFS, and IPSAS reporting requirements. And finally, there is a balance between the information required and the complexity of the coding structure. Okay, that brings me to the end